Hello everyone, my name is Blaine Pearson and I am an instructor in Texas Tech's Personal Financial Planning program. In this video, we're going to look at an overview of beta. To begin, let's first take a look at a few key concepts of what beta is. For any of you who have had econometrics or statistics class, beta is simply the same idea we pull from the beta in a regression. All beta is simply a measure of the systemic risk and the coefficient of systemic risk relative to the market. So a measure of securities volatility relative to the market is what the coefficient implies. So a beta of 1 therefore is the market. A beta of greater than 1 means that the stock or stock fund or even ETF fluctuates more than the market as a whole. A beta of less than 1 means that the stock or stock fund fluctuates less than the market as a whole. For those that are studying for the CFP, beta is simply the standard deviation of your fund times the standard deviation of the market times the correlation coefficient divided by the variance of the market itself. This will give you a coefficient that will tell you how your beta reacts when compared to the market. So let's take a look at a comparison. So here we have a beta of 1.82 and here we have a beta of 0.51. Texas Instruments stock has a beta of 1.82. This red line here is the S&P 500 that the Texas Instruments stock is compared to. As we can see, when there are reactions in the market, this Texas Instruments stock relative to the S&P market has much more fluctuation. If we take a look at a larger stock like General Electric, we can see that these swings are a lot more minimized. Companies that have low betas may include General Electric, Johnson & Johnson, Procter & Gamble, etc. We would expect to see that because they are a much massive company, that the systemic volatility is minimized versus a stock like Texas Instrument or Facebook or Alphabet. When compared to the market, we would expect to see a higher beta. Moving on, how would we measure systemic risk? One way is to look at the stock market as a whole. You can't diversify away from market ups and downs. So how much of a return of stock A is caused by the ups and downs of that market? And that measure is then called beta. And again, just to review, if beta is greater than 1, that means that the stock has a tendency to be riskier than the market because the volatility is higher. And of course, if it's less than 1, there's less systemic risk than the market. This chart shows you an overview of beta and the signs you may see for beta, how to interpret that, and an example of where you would see that at. Notice the first line we did not discuss. A beta of less than 1 would actually imply a short position of a stock. Again, this is Blaine Pearson, and in this video, we covered an overview of beta. Thank you for watching.